Everything you need to know about FHA Non-Occupant CoBorrower coming up. Hey guys, I'm Adam Lesner, and my oxygen is getting borrowers approved for a mortgage when other lenders say that it's just not possible. Today we're diving straight into how to get approved for an FHA Non-Occupant CoBorrower loan. Be sure to subscribe and stick around for the end for the 5 most common frequently asked questions. Let's just jump right into it. Ever wondered how you could help a family member or close friend buy a home even if you don't intend to live there? That's where FHA loans and non-occupant co-borrowers come into play. In this video, we aim to provide a comprehensive guide on this topic. Let's dive right in. The FHA loan landscape. First off, FHA loans are federally housing administration loans designed to help lower income, lower credit, or first-time homebuyers secure a mortgage. These loans are insured by the federal government and generally have lower down payment requirements and more lenient credit score criteria than conventional loans. But what happens if you still can't qualify a loan? That's where co-borrowers come into the picture. Understanding co-borrowers. A co-borrower is someone who applies for a loan along with the primary borrower. The co-borrower's income, assets, and credit score all are taken into account when determining loan qualification. But did you know there are different types of co-borrowers? For FHA loans, a special kind exists called the non-occupant co-borrower. Digging deeper into non-occupant co-borrowers. A non-occupant co-borrower is someone who signs the loan documents and takes on the financial responsibility of the loan, but doesn't live in the property. The typical candidates are parents, close friends, or other family members. Pros and cons of having a non-occupant co-borrower. Having a non-occupant co-borrower can offer advantages like a larger loan amount or expanded eligibility. However, this arrangement also has its downsides, such as shared financial responsibility. Benefits: higher loan amount potential and expanded eligibility for the primary borrower. Risks: shared financial liability and risk of default affecting both parties. Requirements for non-occupying co-borrowers. Lenders usually look for financial stability and a credit score of at least 500. The exact criteria can vary, but both the primary and non-occupant co-borrowers should have stable income sources and acceptable credit scores. Stable income would be the ability to show proof of income or employment over the last 2 years and current employment. The minimum credit score for an FHA loan is 500. Responsibilities of the non-occupant co-borrowers. It's crucial to understand that as a non-occupant co-borrower, you're not just a name on a paper, you share both financial and legal responsibilities. Common scenarios for using non-occupant co-borrowers. First-time homebuyers and those with lower income commonly use non-occupant co-borrowers. These scenarios often need extra financial planning, and that's where a non-occupant co-borrower steps in. Having a non-occupying co-borrower is most commonly used when the primary borrower has unverifiable income or a high debt-to-income ratio. How to add a non-occupant co-borrower. You'll submit a separate application to the primary borrower's lender. You'll provide supporting documents like pay stubs, W-2s, ID, etc. The lender will send both you and the primary borrower a full loan document package to review and e-sign. Be sure to pay close attention to the loan estimate, which breaks down the estimated payment, closing costs, escrows for taxes and insurance, and loan terms. Let's look at this case study of a successful use of a non-occupant co-borrower. Let's consider Mark and his mother Kim, who successfully used this approach to acquire Mark's first home. The case illustrates how a non-occupant co-borrower can make homeownership attainable. The challenge: Mark is your classic young adult striving for that cornerstone of American dream, homeownership. He's financially responsible with established credit, but there's a hiccup. Mark's main source of income is tip-based, earned under the table at the restaurant where he's been a loyal employee for 3 years. While this may offer him flexibility and solid cash flow, it presents a roadblock when it comes to verifying income for a home loan. His favorite lender was optimistic about Mark's prospects, but recommended that the absence of verifiable income could be a make or break factor. That's where a non-occupant co-borrower could tip the scale. The solution: Mark didn't hesitate to bring this dilemma to his parents. The family collectively recognized the value in Mark's owning property at his age, especially given the long-term benefits such as wealth accumulation and tax incentives. Kim, Mark's mother, emerged as the ideal candidate to become a non-occupant co-borrower. She has well-established income history, limited debt, and a vested interest in Mark's financial future. The strategy: Kim's financial credentials provided the necessary yin to Mark's yang. She was essentially able to vouch for Mark's financial responsibility in a way that satisfied lender requirements. This co-borrowing approach is not novel. It's backed by FHA, which allows non-occupant co-borrowers to help secure a mortgage. By leveraging Kim's income, Mark could now substantiate his loan application, increasing his chances of approval. the application, and the approval. After extensive paperwork, which included credit checks, background checks, and the compilation of Kim's financial history, the application was submitted. It's critical to note that this isn't a shortcut, but a legitimate way of proving to lenders that the borrower is reliable. Within weeks, Mark was given the green light. The loan was approved, and he could finally purchase his home. The results: Mark is now a proud homeowner, reaping the benefits of equity and the freedom that comes with it. Kim also gains peace of mind knowing that her financial responsibility has enabled her son to achieve a significant milestone. Moreover, this arrangement has established a positive credit impact for both parties involved. The takeaway: sometimes a traditional lender approach doesn't accommodate modern complexities. The non-occupant co-borrower strategy is not just a loophole, but a testament to the evolving nature of financial planning and familial support. The collaboration between Mark and Kim demonstrates that homeownership is attainable when we think outside the conventional box. The happy ending. And so, Mark sits in his living room, free from the bounds of rent, surrounded by walls he can call his own. The experience has brought him and his mother even closer, strengthening their bond through a joint financial venture that succeeded brilliantly. Mark's case is a shining example, a beacon for many young adults who might find themselves in similar circumstances, illuminating the path to successful homeownership through smart, strategic planning. What Mark and Kim accomplished is not just a purchase, but an investment in the future. One that promises to yield returns in happiness, stability, and financial growth. Truly, a happy ending for a tale of modern-day financial wizardry. Alternative options. If a non-occupant co-borrower isn't suitable for you, there are other options like a no-income verification loan if you have strong credit and assets. Conclusion: whether you're a first-time home buyer looking for ways to fortify your loan application or a financially stable individual considering helping someone else, an FHA loan with a non-occupant co-borrower offers an attractive path to home ownership. With the right planning, a clear understanding of responsibilities, and an eye out for potential pitfalls, this could be the key that unlocks that elusive door to a home. 5 unique FAQs about FHA non-occupant co-borrowers. Number 1. Can a non-occupant co-borrower be removed later? Yes, they can be removed in the future by refinancing once the primary borrower is eligible on their own. Number 2, do non-occupant co-borrowers have to be family members? No, but if they're not family, the maximum loan-to-value ratio is 75%. Number 3, how does being a non-occupant co-borrower affect my credit score? As long as payments are made on time, the mortgage trade line will help strengthen your credit profile over time. Number 4, what happens if the primary borrower defaults on the loan? The non-occupant co-borrower will be equally negatively affected. Number 5, can non-occupant co-borrowers be used for loans other than FHA? Yes, this is allowed on Fannie Mae and Freddie Mac, which are conventional loans as well. That's it, guys. Hopefully that was helpful. If you were thinking about either co-signing for somebody or getting a non-occupant co-borrower, hopefully this answers some questions. If not, drop a comment below with your question and I'm happy to help. Thanks. We'll see you again next time.